Hi, welcome to this Tuesday talk, this edition of Tuesday Talk by QED Capital. Today I'm going to summarize, in the last week of the month. So today I'm going to summarize all that we have discussed over the last 3 or 4 weeks and give you the key takeaways of behavior gap and what causes it. But before that, let's dive right into the markets and see how our factors have performed. And it's not been a bad market at all. In fact, the broader market is up about 3% last week. Low volatility did much better, up about 3.5%, and the combination of momentum and low volatility was also up about 3.5%. So it's been a pretty decent week, overall. On a monthly basis, we are still negative. Small caps down 18%, markets down about 8%. So in spite of the reversal that we saw, a bit of a bounce that we saw last week, the first it still has not been able to make up for the rest of the week fall. And year to date, again the picture doesn't change much. Low vol market and quality have fallen the least year to date. Small caps have taken the biggest hit at about 25%. Momentum is down about 16%, and value is has reversed quite a bit. It's down about 15%. When we look at the sectors, it's very apparent. If you've been watching our videos, you'll know why the value trade has reversed. When we look at trends, none of the factors are in an uptrend. All of them are in a downtrend, same as last week. So no change there. Let's look at the sectors. If you see, the leadership has sort of transitioned from energies and metals to auto and FMCG last week. IT is bouncing back, giving a little bit of relief to investors, but autos had a really stellar week, up about 7% for the week. On a month to date, also, it's only auto which goes home with positive returns this month. Metals and energies, the trade has reversed again. Metals down 27% for the month, energy down 16% of the month, and they were, primarily responsible for dragging the markets down this month. Year to date, also auto is positive. Energy still holding on to its 6% gain, and FMCG is sort of just eking into the green. But IT continues to be the most hit year to date, and that's remained consistent. The pain in IT continues on a sectoral basis. Let's look at the trends. So last week we saw that auto and FMCG are also dipped into a downtrend, but this week they're back above. So they're sort of bobbing their head up and down on the boundary of a trend and trying to sort of break into a trend. That tells us something that, if this is a reversal and not a bear market rally or a dead cat bounce, whatever we want to call it, it's these are some of the sectors that could sort of initiate that rally, so to speak. If you want all this information, again, you can follow us on factorinvestor.substack.com and we'll get it in your inbox. For June, we were in risk off. We'll run our model again on the 30th of June this month, which is Thursday. So on Friday, we will get our new allocation, and we'll know whether we are still in risk on or risk off mode for the month of July. A behavior gap, this is something that I've covered in the last 3 or 4 videos. So today what I'm going to do is I'm just going to talk about, the top 3 or 4 key takeaways that I want you to take away from this whole month. If you've not seen the previous 3 videos, I would recommend that you watch it. It's only about 7-8 minutes each, but I think you would really get a lot out of those videos. And so let's start quickly with the first key takeaway. What is behavior gap? So behavior gap is simply the difference between investment returns and investors' returns, which means if, let's say, an index fund, let's say the Nifty 50 index fund has returned 10%, have you made that entire 10% or have you made less or more than that? So if your return is 8% and the Nifty has returned 10% for the entire year, that means your the balance was caused by behavior gap, assuming all things remaining equal. So that difference is called behavior gap because you tried to time the market in and out. So that caused the difference of 2%, and that is called behavior gap. What causes behavior gap? Behavioral biases, like disposition bias and confirmation bias. Disposition bias is nothing but selling your winners too early and holding on to your losers. And confirmation bias is looking for information which just confirms a pre-existing belief. So we look around for data in the market, in the media, in the news. We have certain preconceived notions and beliefs about the market, and we are looking for data to just confirm that position, and that results in behavior gap. Because remember, you have to be in sync with the market does not have to be in sync with you, and that's somewhere that we go wrong. The third and the most important one that I would say is, you know don't let short term, and even a year or two is short term according to me in markets. Anything less than 5 years is short term in the market. If you are in the market, you have to give it 5 years to play out. We have survived, I showed you that chart. We have survived many 1 in 100 year events over the last 30 years. The US market data is available from 1926 and even before that, but from 1926, a fair amount of credible data is available. Uh, we've been through from 91. We went through liberalization. We went through our gold reserves having to be airlifted because they were collateralized to the World Bank and the IMF. We've been through we've been through the Harshad Mehta scam. We've been through the Asian currency crisis of 1997. We've been through the dot-com bust of 2000. We've been through, between 2004 and 8, we had a stellar bull market, and then we had the great financial crisis in 2008. We've been from going through in the BRICS, which the term coined by Goldman Sachs, we became part of the Fragile Five in 2011 and 12. From there, we bounced back again, and we went through a change in guard at the center. We've been through the demonetization. We've been through Brexit. We've been through Trump being elected as president of the US and surviving his 4-year term. We've been through the implementation of GST, some painful reforms which were necessary, in my opinion, for the long-term development of the country. And the most recent one, COVID, the COVID pandemic, which truly was a black swan, which we had not. Financial crises are something that we can say that we don't know when they will come, how they will come, but we know that they will come. But something like COVID, I don't think we even imagined that the world will be shut down for 2 years, and markets have survived even that. And now we are seeing the impact of inflation, the Ukrainian war, and the reversal of interest rate cuts in the US and quantitative tightening, some amount of that. So I don't think that from a 5 to 10 year basis you have anything to worry. If you are you're going to look at markets every week, every month, every quarter, then you will have to endure that pain, because equity premium is not free. There is no free lunch in the market. The premium that you earn above fixed income has to be earned, and for that pain has to be endured. And markets also deliver returns in a non-linear bunched up basis. Returns are not available here on a pure simple weekly, monthly or yearly basis. You can have 3 years of no returns, and suddenly in the 4th year you can have all the returns bunched up, and in the 5th year again you can have a down market. So remember that the non-linearity throws many people off, and that also I think is a big cause of behavior gap. So remember all of that, and remember that index funds beat most active funds globally and in India. So I would just want you to leave with this quote, which I also ended with last week, which is from Warren Buffett, where he says, "Can you settle for index returns? If you invested in a very low cost index fund and dollar cost averaged or SIP in Indian language, you'll do better than 90% of the people who start investing at the same time." When he says 90% of the people, he's actually talking about uh, active mutual funds is what Warren Buffett is hinting at. So, just a regular disclaimer that nothing in this video should be considered as investment advice. It's purely for educational purposes only. Please consult an investment advisor before investing. Uh, Here is my Twitter handle at Anish Daily. Here is my company's Twitter handle at QED Cap. This is our website. You can go and register, and we'll send you our research as and when we publish, or we send out our weekly write-ups. We send out monthly newsletters with our fact sheet and returns and all the other data. So you can sign up for that, and please like, subscribe, and follow our YouTube channel. Please share the word. We would like more and more of you to come and give us your feedback. Some of you have been sending us your feedback and comments, and we thank you a lot for that. And and so this is it for this month. Next month, if you have any suggestions for topics that you would like us to cover, please put it in the comments section below, and we will definitely take it up for consideration for future episodes. Thank you and have a good week.